Everyone, this is KT here. Today's video is about the weekly trades that are placed between the week of 28th July 2025 to August 1st, 2025. So let's take a look at the portfolio now. For the past 1 week, rather than 7 days, we see that there is a decrease of the portfolio performance in a negative 2.22%. This actually aligned with the scenario that July going into August, when there's a lot of macro events happening. And overall, we can see that the month to date, um, this month, it's August, so actually for 1st of August, it was a plus 0.05%, as compared to a negative 1.6% versus the S&P 500. So going back to the 7 days, slightly better than S&P 500, even though it's a negative return here. Year to date, it's about 66.01%, and since inception, it's about 262.46% versus S&P 500 46.49%. Yeah, so just bear in mind this is the NLV, the net liquidation value. So it does not take into account the true value of the portfolio. It just means that if I were to liquidate now everything, what is my profit and loss here? Okay, so just an indicator, but of course, the closer the NLV to the true value, is the best scenario, because when NLV equals a true value, it means that all the options contract positions that are currently active are already closed, and this is what's your final P&L. Okay, let's take a look at what are the trades that are being placed here. Okay, there's quite a number of trades being placed for this week, so let's see the different counters here. So we look at silver. Silver bought back silver and rolled it to August 8th uh, at the same strike price. Got a credit of about 30 plus cents here. And this is so because the rationale for rolling, as mentioned previously, it's example, if I sold silver puts at $1, and if currently at this time point, if I were to purchase back or close this position, it's less than 50 cents, which means more than 50% of the extrinsic value has been eroded, which means that I have actually gained that premium. Then I will start to roll to a later further expiration date to gain that amount of premium. And the another scenario is example, if I have sold these options at $1, which means I gain $1, and at this current time point, it has uh, I need to spend maybe $1.50 or $2 to buy back this position. Then it means that I need to actually roll to another position to reset the status. So these are the two scenarios that will force the decision of changing my options position. And this is in relationship to the price of the underlying, which is the stocks. So if the stocks goes up or goes down, it will affect the premium to so-called the premium needed to close this contract or close this option. So for this, that's the decision being made here. You can see that the counters that I am rolling, it's silver and also JPM. JPM got a credit of $1.15 for rolling it 1 week later from 15 August to 22nd August. Also, the same cost for IBIT. So uh, for this, I sold IBIT at the starting of the week because I'm very bullish on IBIT. Got a credit of 77 cents. Same goes for ETHA, the Ethereum ETF. sold at $28 strike price, August 1st, for 63 cents credit. So, SoFi calls, I bought SoFi calls on August 1st here, and then um, just to uh, close this, let me take a look. Yeah, so probably I bought back the $26 SoFi calls on August 1st, 2025, because it was a relatively low price, to prevent it getting a sign. This is because SoFi in the week, because of its earnings, it actually went up to 10 to 20%. So was actually quite bullish on SoFi, and was afraid that this naked calls will be a sign. That's why I close SoFi calls for this situation. Debit of 0.19 cents. Next, I also close all my SoFi puts here, so that it was already at a low price to close it, to 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 get out of this position. I think there's a reason why I have said to get out of SoFi, because it is, according to Simply Wall Street, is very overvalued. Um, Next, see, I see I sold SoFi calls, $23 calls here. Mm, mm, I think this is because I actually bought SoFi calls at $23, so it's time to make get the profit here. So overall, this whole position is a net credit position here. So this already happened when SoFi actually moons more than 10 to 20% based on the earnings release. So close the $26 calls that are being sold, bought back the $16 puts that are being sold, and sell away the $23 call that were being bought here. So overall, it's a net credit. Phoenix, GLD. Uh, it's the same here. I think I roll GLD from 285 to 290. I think just to consolidate the strike price here. So got some credit of about 70 to 80 cents here. And just to consolidate my GLD positions. And IBIT here decided to, because IBIT is trending downwards, decided to roll it down to a lower strike price at $66.5 from 67, and 1 day later, so to coincide with the expiration of IBIT. So in the end, overall, it's a net credit due to the quantity sold, and because strike price actually lowered, so I have to sell more quantity in order to get more credit. So Hims was exploding in the week, so I roll it up and for the expiration date here, and got a decent premium of $1.61. And just to consolidate all the Hims position to $55 expiring August 15th. So overall, is a net credit for all the different Hims uh, put options that were being sold from $50 to August 15th 55, and from August 8th 55 to August 15th 55. So overall got a decent of about 60 to 70 cents for rolling at the same strike price. Next, silver also roll from August 8th to August 15th, same strike price. It's got a credit of about uh, 12 cents here. Same for silver at $34, same strike price. Got a credit of about 10 cents. Next, GDXJ price is fluctuating, so that's the reason for rolling the calls here. So in the end, roll from 15 August to August 29, got a credit of about 50 to 60 cents here. And also AAPL, roll it 1 week later to get a credit of 47 cents at the same strike price. Next, there's some silver is trending downwards, so decide to roll it further away, expiration, uh, gaining a credit of 0.06 at the same strike price. Next, purchase VIX calls here because market is trending downwards. Decided to hedge against market, so got a debit of $1.44 for purchasing VIX calls, and close the PDD contracts here on the Friday to harness its remaining residual value, just $5 here. And also market from the last trading day from July going into August, it's actually turning bearish. So JPM calls decided to roll it 1 week later, got $1.65 credit, not only about 2 weeks later to get $1.65 credit here. Same goes for STZ, rolling the puts here to get about $91.05 credit at the same strike price. Same for IBIT. Quite a number of IBIT trades are being done here. It's just rolling forward to August 8 at a lower strike price, actually $6 puts. So just to play around with the quantity and to achieve an overall net credit. SPY bought SPY puts to hedge against the market if it really tanks. And then ETHA, because initially for the week decided wanted to uh, get ETHA assigned so that I sold calls in advance. It's the same for IBIT and ETHA. I wanted to get it assigned and then sell calls for the next week for it to get call away. But after analyzing it is going to be a downward trend for a while. So I decided to just not getting it assigned and just keep on rolling. So what I did is that the calls that were sold, I just buy it back and roll the current options position to a later date. So this is for ETHA why I purchased back these calls. No, this is for ETHA which were being sold here in the first place. Later I will purchase it back. Same go for STZ, also roll 1 week later. Got about 50 cents credit. So this is the rolling of ETH puts to a later expiration date, lower strike price here. And for this, I did not increase the quantity because at a longer uh, expiration date, the premium is actually similar. Overall, it's a net credit here. So you see, I bought back ETHA calls here just to be in the position of just rolling ETHA. So same for IBIT, rolling it to August 15 from August 1st and August 8 at the $65 strike price here. And also bought back the calls so that it is just a rolling position. And also hedge on IBIT by buying puts on IBIT because it's trending downwards here. And next, for SLV, also bought calls for it because it was quite bearish, not was quite bullish on silver in the coming months because market is going to be a downward momentum, and silver are safe havens to go inside. Also bought SVIX puts because it's going to be bearish here, and my SoFi $29 call expired over the weekend. So these are the overall trades that were being placed for this week. I would say market is turning bearish now, and I've put in some hedges here so that when market is going downwards, I will still be able to maintain my accessibility and also get some profit out of it. So the goal here is to ensure my accessibility is not going to zero, to ensure my positions are still inactive so that I can continue to roll and also continue to receive the premium and boost up my accessibility because all the counters that I went in, they are all fundamentally strong, and I believe in the long run it will be bullish. So I just need to keep on rolling until August, September is gone, where October where things are going to be pick up after probably the rate cuts are announced, and then all the positions will be having a bullish price action, and then I will get out of these options position that are being sold. So I think that's all for today. Remember to like this YouTube video and like this YouTube channel. Turn on your notification bell and have a great day, everyone. Yeah, signing off here.